Hello all. Thank you for joining us on this wonderful Saturday afternoon. So today we are going to be talking about the strategy of asset allocation. The strategy of asset allocation and what should an investor be looking at before they go ahead with their asset allocation, as well as if you have a current asset allocation in place, is it okay? Is it good for you? Does it suit your goals? Does it suit your risk preference? Is it something that you should be looking at in further detail? Is what this webinar kind of aims to dwell upon. We'll kind of keep it an interactive session where I'll go through a couple of examples as well, so that this kind of pertains to our life a lot more. So moving on, first thing is before we go on to heavy topics like asset allocation, like where your asset allocation should it be in equity, gold, or debt? I want to deep dive into something of an example. So meet Tarun. He has an asset allocation conundrum, a problem with his asset allocation. So going through his current financial situation, Tarun is 40 years old. He has a family with 2 kids. He works at a private organization and plans to retire at the age of 50. So there are 2 things that are very clear at this point. Tarun has some goals in place that he wants to achieve. One is very evident that he wants to retire early. This is something what we are seeing with a lot of millennials and a lot of new Gen Z people, is that they want to retire early. Not that they won't work, but they want to maybe take on a lighter role. Maybe they want to take on their passions, or maybe they even want to consult. So that is one thing that we are saying. Another is, since he has 2 kids, he would want to provide for their education. So these 2 goals are evident from this. Moving on. Again, his major goals would be his children's education, buying a home, and retirement. Now, another goal pops up. Tarun also wants to go for buying a home to live in. Now, this is another conundrum because buying a home entails some part of an EMI, and especially if he wants to retire early, how can he make sure this EMI is factored into his early retirement corpus? That is one more thing that we should be looking at. Right now, 80% of Tarun's net worth is concentrated in traditional assets. This can be a real estate, this can be lands, this can be plots, this can be flats. So these are your physical assets. These can be things like gold, silver, coins, bullions, bars, jewelries as well. And balance 20% is spread between your mutual funds and your EPF. EPF is something that is generated in your on the job itself, where you contribute as well as your company contributes. Mutual fund is something where he's been making investments in. Now, I want to draw your attention to one thing. Tarun's asset allocation right now is extremely skewed in favor of physical assets like real estate, gold, and things like that. And only 20% of his net worth is in assets like mutual funds and EPF. Now, this in itself is a pretty big problem because physical assets, especially with the goals that Tarun has, becomes very hard to meet with. See, if you have a real estate property and you want to, let's say, provide for your children's education, this will have to be converted into liquid assets like cash. To do that, the real estate might take maybe a year, maybe 6 months, maybe 10 years to convert. This is where most of the problem comes in. If this is a real estate that bears rent, then some part of the rent can maybe be invested in liquid assets to kind of store it up. But what we've seen is that most people have this kind of assets in things like plots and lands, where it is property that is not generating any kind of net worth. So now one crucial thing that Tarun will need to do is, there's actually 2 things. One, he'll have to make sure a little bit of the real estate pie is moved towards liquid assets like, again, mutual funds, fixed deposit, bonds, or whatever that might be. Or the future kind of investments from his cash flow will kind of be will have to go towards things like mutual funds or fixed deposits or EPF or bonds or debt funds or things like this. So his asset allocation is skewed in favor of real estate. He'll have to correct it so that real estate forms maybe 45 or 50% of his net worth, and the rest is in mutual funds so that these can provide for his goals. Now that is out of the way, these are some of the questions that not only has Tarun, but we should ask ourselves as investors. See, investing in a mutual fund or investing in a fixed deposit or investing in a debt fund can all come at a later stage. But first, what we should kind of aim is, what is the ideal future allocation that Tarun or we should aim for? See, this is a very, very unique question because now we don't know that the Tarun's goals and investor goals or the people in this webinar, your goals might be different. You might say, Acha, I'm okay to work until 60, but I want a bigger house. I want to buy a car. I want to make sure that I have a vacation corpus every year. So your asset allocation will automatically differ from someone like Tarun. But Tarun now maybe would want to postpone his real estate purchase and concentrate more towards liquid and financial assets. So this is where the asset allocation pie will depend on what the investor needs. Having a higher real estate asset allocation is not suitable for someone who has very liquid goals, like let's say retirement, or let's say if you want to buy something. This is not very this won't suit the purpose of the goal. So for liquid goals, you need liquid assets. For maybe goals like inheritance, for maybe goals like if you want to construct a property, real estate would do well. Second is, how can you map these assets towards this financial goals? See, very simple. If you have your retirement, and let's say you are maybe saving in NPS, maybe you're saving in your provident funds, maybe a PPF is in place. All of these assets are automatically assets that will be tagged towards your retirement because they have a hard lock-in in place. In the place of NPS, it's 60. In the place of EPF, yes, you can withdraw it earlier, but there is some kind of lock-in in place. There is some kind of restriction in place. So tagging your assets towards your financial goals becomes very, very important. Third is, more importantly, let's say you have asset allocation right now. Let's say you have also come upon a proposed allocation which you want to be at. How can you rebalance your asset allocation? This is very, very important. This is the place where I see a lot of people, even a lot of people that I've been interacting with recently, say, I know where I want to be, but I'm finding it hard to rebalance my asset allocation because if it is locked in either ULIP policies, or if it's locked in LIC policies, or if it's locked in, let's say, things like real estate, it becomes much harder to rebalance than one can imagine. This whole rebalancing process itself can take maybe 2-3 years, where to get to your asset allocation, you'll kind of have to keep working on this. So rebalancing is something that is to be actively worked on and is not something that can be thought of and passively left off. And number 4 is, does he have enough reserve for contingencies? This is equally important because for a person like Tarun, since he has a higher asset allocation towards real estate, any kind of emergency will have to be met up either from his existing savings in mutual funds or his existing kind of EPF, which he'll have to withdraw. Both are circumstances where this is not optimal. So he will first have to build a contingency reserve in place so that his other investments are safely in place. What is the family's insurance coverage for unforeseen events? This is equally important again, because let's say something does happen to Tarun. First, he leaves his family with a lot of fixed assets, which they might find hard to monetize in his demise. So having a plan in place for that is very important. Another thing is, you take a good term insurance, you take a good health insurance, you forget about insurance after that. You do not need any kind of insurance. Let investments take care of themselves in instruments like mutual funds and bonds, and let your insurances kind of take care of any unforeseen events that might happen. Let's say Tarun has an insurance cover of 3 crores. In the event that something happens to him, the insurance provider would pay him, let's say, an amount of 3 crores. So that should kind of be able to take care of his family's expenses as well as his own goals. So he has to provide for his kids' education, right? So that is where a term insurance policy is really crucial and it comes in place. So even for any investor, posing these questions to yourself and getting these answers out of your own, because it is going to be different for every investor, because every investor wants something different. So getting your own answers from this will be the base for forming your asset allocation. Once the asset allocation is formed, you can go about investing in different kinds of assets. Now that that is in place, again, coming to the point where what works for you might not work for others. No, I'll just give you a very simple example. Let's say investing in mutual funds or having a big liquid corpus works for me. So I continue to doing that. But you might be some person where you might think mutual funds or something is not where I want to be at. I want to be in things like FDs, fixed deposit, bonds, and safer instruments where I want to have a lot more asset allocation towards liquid assets. It's not that I don't want to do equity, but it is just that I want to have a larger allocation towards fixed assets. So this is where it becomes very, very important to assess each and every investor's risk score as well as your risk appetite and your risk capacity. See, your risk appetite might be higher, but your risk capacity might not be that high. For example, let's say someone is earning 2 lakhs per month in hand. They're able to invest a lakh a month. That might be their kind of risk capacity. But let's say someone is earning only 50,000 per month, but they want to invest a lot more amount. This is where the risk capacity will kind of come into question, where your risk capacity might be constrained, but your risk appetite must be on the higher side. So both of these kind of have to match for an investor to kind of be in a good place. Moving on, I just want to start off with a metaphor from football, from the game of football. So if you look at a game of football, it's 11 versus 11. Just like the formation of players help them to kind of form either a defensive formation or an offensive formation, or a formation where you have a bigger midfield in place, or maybe you have a lot more kind of aggressive kind of players at the front. This is where your asset allocation can be thought of. See, if I am someone who's in 25 or 30, I can have a much higher attacking formation. Attacking formation is where I can invest in assets which can potentially yield me higher returns, like equity markets and mutual funds, where I still have time horizon for my goals, time horizon to kind of invest in. So this is where kind of the formation kind of comes into place. And slowly and surely, this attacking formation, I kind of move it backwards to a defensive formation in my retirement years. So this is how a formation should be thought of. The formation in football can equally apply to your asset allocation as well. Being aggressive when you need to is equally important as being defensive, because only by being aggressive, you might be able to create good amounts of wealth. And being defensive can help you sustain that wealth, can help you generate incomes out of that wealth. Now, before we go ahead with specific questions that we want to answer, I want to just talk about the assets that are in the conundrum. So now we know that the questions that an investor needs to ask him before he goes ahead with, let's say, something like, okay, I want to, this is my proposed asset allocation. Now we are going to go ahead with the assets that will be part of that asset allocation. First is your cash and cash equivalents. This is things like your liquid funds. This is just cash lying in the savings bank account. This is very safe, very liquid. This is where Tarun should have kept his contingency reserves in mind. 6 to 8 months of expenses should be here. Gold and silver, good proxy for inflation. But if it is in the form of jewelry, or if it is in the form of, let's say, coins and stuff, it will kind of lose a bit of its value. And in the Indian context, we never go about monetizing these assets. No one is going to go and sell jewelry. No one is going to go and sell like gold bars or gold coins. This is just traditional assets that is just on the books, but you do not consider this. Maybe 5 to 10% of your net worth can be considered. Provident fund, fixed deposits, excellent places for, let's say, people who are conservative, people who are closing to their retirement, people who are in their retirement to have their wealth in. Again, real estate, capital intensive asset, to be careful about how much money you put in, especially for people who take a larger amount of home loan to kind of service it in their early stages of their career. And equity. And equity is kind of an investment where it kind of can go into any of these buckets as well, because equity can be easily liquidated to kind of form any other asset class that is on your screen as well. I can kind of liquidate my equity and put it inside a real estate, put it in an FD, put it in, let's say, something like a gold bar as well. But to liquidate something like a real estate, it takes some time. So it is not that real estate is a bad investment. It is just that knowing its constraints is important before you go ahead with a high ticket purchase. Before I move on to more specific questions that on asset allocation that my colleague Vinayak will answer, I want to kind of preface things on this kind of code. See, if you look at it, every year you have different assets that are in the pipeline. So this is a quilt containing different assets and their early yearly returns. So, for example, in 2022 and 2023, gold has performed pretty well because of the high inflation scenarios and central banks throughout the world kind of going and buying gold, this is where an kind of an asset allocation approach or a multi-asset kind of approach becomes crucial. See, having a multi-asset kind of approach means that you have a kind of exposure to precious metals. You have exposure to different kind of debt instruments, like let's say FDs, corporate bonds, maybe debt funds, liquid funds. You have exposure to equities in the form of, let's say, global equities, your Indian equities, large caps, small caps, maybe a little bit of index ETFs, or maybe a little bit of sectoral ETFs. You have exposure to maybe real estate as well. This is where a multi-asset exposure is very, very helpful, because it helps you determine how each year, even if one or two maybe asset classes do not perform well, you have other asset classes that kind of can compensate for it. If you are solely invested in one or two asset classes, then it is a risk that you do not want to take. This is a risk that can be easily diversified away. So you do not want to take a lot of idiosyncratic risk, a risk that is particular to only one asset class. You want to take risk that is kind of maybe diversifiable. You can kind of want to take risk that, okay, if I'm going to be invested in equities, I want to be at a particular asset class where that risk can kind of be, I can take that. But you don't want to be only in equities. You also want a little bit of precious metals. You also want a little bit of global kind of investments in your portfolio. So that is where every year, kind of every investment performs kind of in a cyclical manner. Every asset is cyclical. So keeping that in mind is equally important when you kind of have your asset allocation in place. Now, moving on, the deciding factor, determinants of portfolio return variability. Asset allocation is one of the most important decisions, because if you look at it, your return that you're generating from things like security selection or timing the market, it is very, very low. But if you are a buy and hold investor who had bought an asset allocation, and let's say he kind of rebalanced it going forward, his asset allocation is which is contributing to most of his return. If you look at things like market timing, which has always played a very, very little role, the kind of data kind of backs it, where it plays an even lesser role in generating the total return. Security selection plays a decent enough role. Asset allocation plays the majority of the role. So having your asset allocation in place is even more important than maybe choosing one security or going for market timing, which you can see that it doesn't even add any value to your portfolio. Now, I'm passing it on to Vinayak, who will talk a lot more on fostering the investment landscape. He'll talk more on how different kind of investment avenues, how different kind of asset allocation kind of talks on it.
So thank you, Nakul, for the brief explanation about importance and feature of multi-asset investing. And it's like right now, as you already said, there are a lot of investment avenues. It's like equity, debt, precious metals, cash, like even foreign investments, right? So in that, it's like obviously based on your investment horizon, based on your financial goal, your asset allocation is going to be different. And the previous side, as Nakul had mentioned, as per the studies by Vanguard, it's proven that asset allocation can influence up to 90% of your portfolio's returns over the long term, whereas security selection and the other market timings may be a very mere role. So we should focus on the big picture and focus on a right asset mix on stocks, bond, cash, and etc. So right now there are a lot of fixed income instruments that give good yield and it's like good coupon rate. It's like why not? It's like why are we focusing directly right now only 90% in equity? Why are we not diversifying into other products that are available in the market? So it's like with this multi-asset strategy, let's see it's like how we can reach our financial goals and how we can make most of it. So yeah, one thing would be multi-asset investing helps you ride out the waves of the market and with smaller dips in the value. So lower drawdowns is one important thing. Competitive returns. So it offers the potential for steady growth by capturing returns from various asset classes. So it's like as we had that asset mix chart, it's like you might have seen there's no specific asset class that have always outperformed for a certain set of years. It's like hence having the right set of asset mix is always better for the steady growth of your portfolio. Less dispersion. Yeah. So exactly experience, it will help you experience in smooth sailing with reduced ups and downs in your portfolio value. Apart from that, what is the most important factor would be this would be suitable for your continuous participation. So you can stay invested for a long haul without worrying about the market timing. So that is the one thing. Apart from that, this is also suitable for a wide range of investors this would be tailored for your specific risk profile, for your specific financial goals, and hence it's like it will help you ride the investment roller coaster at your own pace. So that would be the important factor. So we can move to the next slide. So yeah, so you might ask us like, what is personal finance? So in personal finance, it's like it's very personal, right? So everyone's story is different. So who are your dependents? How long you need to support your dependents? What would you like to provide for them? What are your aspirations? Which career stage are you in? How much risk you can afford to take and how much risk are you willing to take? So hence all these things are different. So whenever there is a financial plan implemented, it's going to be tailor-made for the specific clients, a specific investors, entire financial personal finance history. So hence that would be the case. And let's see, it's like, what are the other features of the multi-asset investing that can help us out? We can move to the next slide. Yeah. So, right. Why is, apart from that, we spoke a lot about investing into multi-asset products, making good returns over a long period of time, rather than having more focus on stock selection or etc. on other factors. So apart from that, what is one of the most important factor in the multi-asset strategy story? Rebalancing and review. So why to rebalance and review? One thing is protect your profits. Suppose, for example, if 4 years, before 4 years, it's like any investor participated in the small and mid cap story, they might have made a good profit this last financial year. And hence, it would be a right time to book profits and look for other investment avenues. Hence, protect your profit. Capture new opportunities. So right now, there are a lot of asset classes mix that give you good returns over a long period of time. Specifically, if you see, it's like there's a product called a sovereign gold bond. So if you're investing into gold as a jewelry, as Nakul said, you would hold some emotional value, and it's not a right product to align to your financial goal. Hence, product like a sovereign gold bond or gold ETFs and our products are there. So sovereign gold bond as a product has given around about 20 to 24% CAGR for last 8 years. So hence, it's like overall asset allocation matters. And right now, based on current market conditions and current market opportunities, we have to be steady and capture the new opportunities that are available. Moving on to the next slide. So when do we have to review and rebalance our portfolio? So cyclical changes. So this cyclical changes will present you the opportunities to adjust your portfolio and potentially boost your returns of your overall asset allocation. So by reviewing your asset allocation during a downturn, you might identify any undervalued asset classes and strategically rebalance it to capture the potential growth over a long period of time when the market obviously recovers. And obviously when the target return exits. So what happens is, suppose for example, it's like if you're investing in the equity product, and your target return is for cert. Not able to see the slide. Is the slide visible? Yeah. So we'll be resharing the PPT. Yeah, I hope it's visible now. So the main focus would be, it's like whenever it's like we have an opportunity, whenever there's a cycle change, whenever your portfolio balances out. Suppose, for example, if you're starting asset allocation right now and you're mapping 20% towards equity, 20% towards debt and so on. And when this certain allocation also expands, you can also have a proper review that can be done. So moving on to the next slide. So how often should you rebalance and review? Even if you implement asset allocation, there's no need to like continuously daily sit and track your asset allocation. Let your portfolio do the work for you, and you can gradually review once in 6 months your portfolio, and you can tune in your portfolio based on your financial allocation and your financial goals. So you need to align it with your investment horizon too. Suppose, for example, if I have a goal 2 years or 3 years down the line, I can't map an equity product towards a specific goal, right? Because it's going to be too volatile for the specific short-term horizon. So for that, it's like there are a lot of products like even FD, short-term debt instruments, money market funds, and etc. So these are the other things that you have to consider in your overall asset allocation. You have to consider the investment horizon. So based on that, actually, again, your asset allocation is going to be tuned in and your asset allocation is going to be changed. So moving on to the next slide. So yeah, for multi-asset investing, it's like you might have heard about a lot of multi-asset hybrid mutual funds, NPS. NPS, it's like obviously we all know we have different investment options that we can select in NPS. So one would be equity, corporate debt, government bonds, and AF products too. So apart from that, it's like, okay, NPS, we have the control of review and rebalance, but obviously there's a lock-in factor of 60 to 70 years till your retirement. Apart from that, there are this other products called as multi-asset hybrid mutual funds and multi-asset portfolio management services. So in PMS services, as per the SEBI mandate, the minimum investment size would be 50 lakhs. And suppose, for example, if you say it's like, okay, you would like to start with a smaller amount, then obviously there is multi-asset hybrid mutual funds that you can start with. So obviously there would be difference in the investment deployment and other strategies and etc. But these are the main multi-asset products that you can look for in adding into your overall portfolio. So yeah. So more about building a portfolio of investments. So as we already spoke about fixed income. So there are deposits, government savings, investment schemes, like literally when post office monthly income scheme that gives steady monthly interest rate. And for senior citizens, there are senior citizen savings schemes and etc. So in this case, there are a wide variety of options that are available in the fixed income options too. Apart from that, in equity, there are stocks, direct stocks, equity mutual funds, PMS services, and etc. And in precious metals, obviously, it's like we have gold, silver, sovereign gold bonds, gold mutual funds, ETFs. In global investments, right now we have option to invest directly via stocks, mutual funds, domestic mutual funds, fund of funds, and ETFs, and etc. So it's like in this overall asset allocation picture, you might ask, it's like, what would be the right asset allocation pick for you? So again, that would depend upon your story. What is your financial goal? What is your investment time horizon? What is the total asset allocation, total net worth that you're already starting with? So that would again differ, and that would again, it's like working needs to be done for the specific thing. Because it's like when right now we as a financial planners, when we see, it's like specific client maybe having 80% of their total net worth or asset allocation just in traditional assets like property or fixed deposit. As Nakul rightly said, to beat inflation and to actually, it's like we hold emotional and sentiment value for the property or real estate. Even if you're mapping a real estate property for a retirement goal, it's not that easy. It's like to get a buyer at the right time. It's like there's a lot of liquidity issues and etc. Hence, for your financial goals, financial assets are more important. And yeah, that would be it. And yeah, hence building a portfolio of investment is very important. So it's like, okay, you might say it's like, what are the pitfalls of do it yourself investing? So one thing would be, it's like mostly all the investors focus only on past performance. As we all say, it's like there's an example of driving on a straight road, seeing just the back mirror. So that's not a right strategy to pick a specific mutual fund or etc. Just focusing only on the past performance. Maybe that specific fund has already peaked out, and maybe it's gonna have a specific downfall or drawdown or etc. So hence focusing just on the past performance is not the right strategy. Apart from that, irregular reviews. So when you work with an advisor, when you work with an investment advisor or financial planner, the reviews are done on track, and you are also aware about what is the right status and the regarding the right current market valuation, etc., where your portfolio stands. So reviews will help you out in that. And obviously, there are limited fund research. There are around about 2,500 plus mutual funds that are available in the market. So how are you gonna like figure out it's like what is the right mutual fund scheme for my specific goal and what is a right multi-asset strategy for my specific goal? So hence, it's like for this work, it's like there's a specific strategy team that they work in and help you choose the right fund for your specific goal. That would be it. And okay, and one thing would be, it's like assuming commissions are bad. So one example I would say is, it's like there are two options, maybe like direct plan and regular plan. More investors are hesitant in going in regular plans and working with any other distributor, and they would like to stick in direct plans. But where they miss out on would be, okay, the expense ratio might be slightly higher, but they miss out on the thing that it's like there would be regular reviews, there would be regular call to action on the investment options and etc. So hence, it's like assuming just commissions are bad is not the right strategy. So these are some investing pitfalls. So rightly, what are the advantages of mutual funds? So suitability. It's like for a wide variety of people, it's like there are different financial goals and etc. There are different people. Those who would like to start with a smaller amount, larger amount, lump sum, SIP, etc. And this mutual fund product is one thing that is suitable for everyone. Diversity. it's like in equity, if you're gonna buy and invest and compound your wealth in a specific stock alone, there's a high risk of, it's like if there's this biggest drawdown in the specific stock, your entire net worth might come down. So hence it's very important to diversify, like not to put all your eggs in one basket, like we always say. It's like in mutual funds, we have a wide range of options like hybrid funds, arbitrage funds, multi-asset strategy, etc. Apart from that, liquidity. In NPS, there's a lock-in period of long term, but one thing would be in mutual funds, there's a liquidity. If you need a certain amount in your bank account due to some emergency reserve, etc., you can get it in within 2 days in your bank account. Apart from that, mutual fund is a place, it's very regulated by the SEBI. And hence, it's like that's pretty much safe. That would assume. So like obviously, there would be certain risk of market volatility and etc. But SEBI has always had a good oversight and it's well regulated by the board. Apart from that, it is available for a variety of investors. It's like, as I said, whether it is a small investor who's starting with a smaller amount, whether it is just an investor who wants to start an SIP of 2 lakh to 5 lakhs too. There are a variety of options available. And apart from that, one thing that we always need to focus on, mutual fund is one of the best way to include discipline in your entire investment journey. And obviously, it's like apart from that, there would be a lot of flexibility too. Suppose, for example, if you are not able to like add in or put in funds in your specific mutual fund scheme for the next SIP date or for next month, you have the complete flexibility of pausing for the next month and adding again on the third month. So that would be it. More about the advantages of the mutual funds part. Yeah. So yeah, one thing would be, it's like, okay, we all are already investing. That's what I assume. And hence it's like most of us, it's like we're not aware about for what goal we are investing in right now. So hence planning your finances allow you to write your own story. That would be the main goal that we would like to portray. So yeah, what are the benefits of getting a financial plan from the SEBI registered investment advisors? So it's like one thing would be, it's like we'll take it step by step. We help you create a budget. It's like maybe it's like monthly inflow, cash flow. We'll help you optimize what is the right way to increase your savings potential. Apart from that, we help you in figuring out, suppose if you're underinsured, it's like what is the exact cover you need to cover your dependents if any mishap happens to you. Apart from that, we help you in figuring out how to reduce your tax liability, because we anyways can't skip taxes. So we help you out in figuring out what is the best tax regime that you can choose in and how to efficiently and effectively reduce the tax liability. Apart from that, we also help you diversify your savings based on your financial goals, based on your risk appetite, and based on your investment time horizon. And suppose, for example, if you have a lot of loans that you would like to consolidate, you would help with a debt strategy plan in repayment of this and closure of the specific loans. And apart from that, obviously, I will help you plan towards your future financial goals. So yeah, so what we are going to do is we'll help you guide towards your future portfolio with a balanced portfolio approach that will help you withstand volatility in the market. So I guess that would be it from my and Nakul's end, and we are open to questions.
Please let us know if you guys have any questions. Do drop them in the chat box. We'll be more than happy to answer them. So first question from Tarun, is it necessary to book profits in flexi hybrid fund? Isn't the role of fund manager to rebalance among sectors or instruments based on the valuation and other factors? I have a couple of funds with 2x absolute returns. So one thing to consider is that, yes, it is the role of the fund manager to kind of rebalance in these funds, but the style and the stock picking is where kind of the fund managers and kind of what the market is kind of doing can vary. See, if the portfolio is something that is kind of positioned for the future, then it's okay. You invest for future returns, and with a portfolio that is positioned for the future, that's okay. But what we are seeing a lot is mutual funds have a portfolio that was previously positioned like 5 years before, that was positioned for today. That portfolio is the one that is still existing. So even hybrid funds and flexi cap funds are not doing this. And one more thing with hybrid funds is it is better to have a granular asset allocation in place, sir. You can just have a pure equity fund and a pure debt fund in place. See, in a bull market, every single asset class is going to go up. It is only when the bull market stops, the real kind of returns of a fund kind of end up showing. So you have to kind of judging your funds only based on a bull market is kind of not the right way to do it. Over a long term, if your funds do have a consistent philosophy in mind, if the stock selection is okay, they will perform pretty well. Is it your PMS asset allocation product? Yes, sir. So we do have our own PMS Sphere. It kind of does the asset allocation inside the product itself. So it is a product which can do your equities, ETFs, mutual funds, global mutual funds, your commodities, gold, silver, whatnot. So it is a product with a diverse asset allocation is kind of all of it is in place. So if you're someone who is thinking, okay, instead of having like mutual funds in one place or equities in one place, I'd rather give it to Sphere with it taking care of everything on its own. It's a dynamic asset allocation, meaning it will kind of go where the kind of market is kind of headed. So it'll kind of do internal rebalancing of the asset allocation as well. So Sphere is a very, very dynamic product. We had Sphere, we have been having Sphere as a product under our registered investment advisory wing for a pretty long time. And then we kind of productized it into a PMS under the Sphere banner. So yeah, it kind of is a very efficient product in that manner. The takeaway is asset allocation 100% accepted. As you mentioned, asset allocation is deferred to investors also, but I feel successful as in fixed with what do you think about it? Sir, you can have a fixed asset allocation in place, sir. The only thing is, let's say I have fixed allocation of, let's say 60% real estate and 40% equity. Let's say the value of this real estate appreciates from 60% to, let's say, 80%. Now it would be a good time for me to kind of rebalance some of this real estate gains through sale and put it into equity. The same for any asset class. Let's say equity kind of performs really well. It would be okay for me to kind of rebalance to that 40% fixed allocation line. So having a fixed asset allocation is okay, but rebalancing is what the real need of the hour is. How much equity allocation percentage now in it? Sir, I think Sphere will have an equity allocation percentage of close to 70 to 75%. It is slightly tilted more towards equity right now because this is a good time to buy. Of course, it will have things like gold, silver as well in it. Do drop us maybe a mail, or you can contact us. I'll show us our contact information as well. We'll be kind of happy to kind of get in touch with you. My colleague Vinayak will drop our contact numbers in the chat as well. We'll kind of be happy to get in touch with you as well to take you more on the PMS side, the asset allocation side, whatever your need might be. Shaktish sir asks, silver asset investment is good or gold? Sir, why not have both? Silver and asset are traditionally been asset classes which kind of move in the same direction, with the correlation between gold and silver being high. So if you look at it, when gold moves up, silver also moves up, but in a proportion that is different from gold. So yeah, gold and silver are something that we are both bullish on. Thanks and appreciate for the presentation. Thank you for your comments, sir. That's too much equity bias. Asset allocation means not necessarily to be equally spread across asset class. Sir, so how it works in Sphere is that Sphere goes where the opportunity is, where it is more attractively valued. Asset allocation is something that does not have to be fixed. It can be a dynamic asset allocation product. So let's say if there is too much equity. If you look at 2 years back, Sphere had a lot more kind of global assets, a lot more gold in the portfolio. If you look at it, we have now even more kind of debt also in the portfolio that is coming up, because debt is also becoming more attractive. So this is a thing where Sphere is dynamic in the sense that it will kind of rebalance on what the asset class is, the valuation is at this point. If we think that equity is kind of value cheap and we can buy more into it, we'll buy more equity. If we want to buy debt, Sphere will buy debt through mutual funds as well. So that's the kind of thing that Sphere has. It is a dynamic asset allocation. It is not fixed as, let's say, 20% equity or 20% debt. It will move based on market opportunities. question outside this topic, probably. Why PMS has minimum 50 lakh investment can be brought to less so that smaller investors can buy? So that's a very good question. But the only thing is, this is a regulation that is in place. So every PMS in India is a 50 lakhs investment. So every PMS in India is a 50 lakhs investment. So this is something where we are, so wherever PMS you go, it is a 50 lakhs investment as well. If you want something with a lower capital in place, mutual funds, we can help you through the mutual funds route as well, because even there in mutual funds, we can buy multi-assets. Of course, we won't buy direct stocks, but you can buy gold through mutual funds, silver through mutual funds, global mutual funds are available, Indian equity mutual funds are available. So yeah, for PMS, it's 50 lakhs, sir. If you guys do have any other questions, do drop them in the chat. We'll be more than happy to answer. With too much euphoria all around us over hyper products is not fair. So that is very true. That is why inside Sphere, we not deploy everything on day one. So how it works is that, let's say you give us 50 lakhs. We park that in a combination of, let's say, debt funds, liquid funds, and we kind of keep it there. And as and when we get opportunities, we will kind of deploy it in a strategic way where we'll take some cash from liquid and buy it. So the deployment is something where you can expect it to be maybe 6 months or 8 months. So that's how it works. Not everything is deployed on day one. But if you look at a mutual fund, this is slightly different there, because mutual funds have a mandate that when you kind of invest in a mutual fund, all of the equity is bought in day one. With a PMS, it is not a model portfolio. We can kind of hold it in cash, we can kind of hold it in debt, and we can kind of invest based on opportunities. Is this good time to buy debt mutual funds? No, as emergency portfolio per se. Yes, sir. This is a very good time to do debt mutual funds. Liquid funds or short-term funds or savings funds are good options where you can kind of park your emergency corpus in. Maybe 6 months or 8 months of emergency corpus can be parked there. But as Warren Buffett says, feel greedy when others are wise. So now it's all greed always. So it's not time to be fearful in careful allocation rather than high 70 to 75% equity ratio. So 70 to 75% equity is on the overall portfolio. So for a new investor that comes in, that's not how it will work. So how it will work is, for a new investor, we'll maybe do 25% deployment, which will be in a combination of, let's say, gold, equity, and debt. And the rest will be in cash and liquid funds. So for a new investor who's coming in, it won't be 70 to 75% equity. The asset allocation will vary. So that is why it's not a model portfolio. This is a customized portfolio. For a question, I have 50 lakhs. Can we bulk investment with workable asset allocation? Will you do this? Yes, sir. We do this. Please, Bala sir, do reach out to us. The contacts of us are above. We'll be more than happy to help you with this. Either through the PMS route or through the mutual fund route, we can kind of work on that. Trying to understand difference between a PMS and a MF. PMS also have a set of stock instruments, right? What are advantages in PMS? Sir, with a PMS, it's simple, sir. Let's say you go and buy a mutual fund. All of your capital is invested in day one. But in a PMS, it does not work like that, where let's say someone who had started 6 months back, and let's say you start now, your portfolios are going to look slightly different, because we form a portfolio on the current market conditions for you. But on a mutual fund, the stocks are going to be the same, whether you for anyone that invests at that one point in time. So that's how it works. It's a more customized portfolio. Again, we can hold it in cash. In a mutual fund, in an equity, pure equity fund, all of it is deployed in equity. They'll have to buy it. That's how mutual funds work. Here, we do not follow that kind of approach. We'll hold it in cash, we'll hold it in liquid, and we'll deploy it whenever we find opportunities in place. So valuation, we are very valuation conscious. So we kind of deploy only when we think the valuation is in place. So of course, 6 months, after 6 months, market might have moved a little bit, maybe on the downside. At that time, we'll be able to kind of buy more stocks for you at favorable valuations. What's the redemption of debt funds, T+1 or same day? I think you're right, it is T+1. It should be T+1 maturity. What is your opinion on corporate or GSEC bond investment? So right now, if you look at it, the repo rate is somewhere from 5.25 to 5.65%. So if you want to lock into things like GSEC, this is a very, very good opportunity, because how it works in debt is that once, let's say we think the interest rates have maybe kind of topped up, once interest rates start to fall, bonds prices will start to rise. So interest rates and bonds have an inverse relationship in place. When interest rates go down, bond prices go up. When interest rates go up, bond prices go down. So this is a very good time to lock into GSEC investments. So yes, if you want to invest a lump sum, GSEC investments are really good. We also have corporate bond investments in place as well, where they give you good kind of returns as well. But one thing to note about corporate bonds is these are locked in investments. If you want to sell, this is a more of a kind of a buy and hold kind of thing, rather than you want selling. As there's an option to sell, but it's a kind of a harder thing to do. In Sphere, is there any minimum investment similar to PMS? So Sphere is a PMS product. PMS all have 50 lakhs as the minimum investment. If you go for a PMS, it is 50 lakhs. Instead of stock-based PMS and minimum 50 lakhs, can't you do MF-based PMS build up with such minimum? PMS itself is 50 lakhs. So if we go for the PMS route, whether we do mutual funds or whether we do stocks, we will have to do 50 lakhs. So that is something that, but if we kind of come to the mutual fund space, we can just do, we have another wing, a mutual fund distribution wing, where we kind of curate portfolios for investors just with mutual funds, with only mutual funds in place. Maybe under that wing, I can kind of help you kind of craft your own portfolio. We'll kind of be doing the same thing of reviewing and rebalancing under that wing as well. So if not the PMS, the mutual fund wing, we'll just do PMS, we'll just do mutual funds. And with mutual funds, there is no minimum investment. You can do whatever amount you want. SIPs are good, lump sum is good. So whatever that is, we can do. But PMS as a product, we'll have to do 50 lakhs because of regulations in place. If I have short-term goal in next 1 year, what do you think is the best asset allocation? Do any debt funds make sense for 1 year goal? Yes, sir. Debt funds will only make sense. Debt funds and fixed deposits will make sense for a short-term goal of 1 year. Let's say if interest rate not going down for next 1 year, how is the return for debt funds? So that is okay, sir. Debt funds will anyway earn a higher rate of return. The interest rate going up and down is only for government securities, because there will be a capital gain in place. So let's say your repo rate is still high. That means you will continue to earn a higher rate of interest on your existing debt mutual funds. OIC, and is it regular plans? Yes, sir. Under the mutual fund distribution wing, we do it under regular plans. Correct. We have our own, I now understand. I guess your MFD are in selling. Correct, sir. We are an MFD. We do regular plans under the mutual fund wing. We kind of have our own portal. We kind of have our own research team where we have 13 years of mutual fund research to go with it. So yeah, we curate portfolios there as well. Can direct plans like RIA not handle? So before Sphere became a PMS, we did the RIA thing, sir. So we did the RIA thing, which it was not called a Sphere, but it was still an RIA thing. We have the RIA license as well, but why we don't do it right now is because of the kind of regulatory kind of things that have to go with RIA is not something that we already do. Because operationally also it becomes very hard for us, because in a PMS, we can kind of do the execution when we want. But in RAA, let's say what kind of problems that we faced was, we would raise an investment request on our end for the investor. The investor maybe approves it maybe 1 week later, or maybe he forgets to approve it. At that time, the opportunity cost of investing goes away. So operationally, RAA was a very big problem for us. That is why we kind of moved out of the space. Right now, we either do PMS or we do mutual funds. Under the PMS, all mutual funds are bought under the direct plan only. How much can we earn in debt funds in 1 year? Is it more than FD returns? Please suggest a good category for debt funds. Are there any many different categories keeping financial goals of 1 year in place? So for 1 year, I think liquid funds and short-term funds usually work better, sir. Is it more than FD returns? It will be similar to FD returns, maybe slightly on the higher side. But one thing is, with an FD, it is taxed even if you do not withdraw it. With debt funds, the tax can be kind of deferred away, can be pushed. You are only taxed when you take the money out from the debt funds. But in an FD, TDS on interest is charged every quarter. So debt funds kind of win out there, sir. Do contact us. We'll be happy to help you with assistance on the debt fund as well. So if you guys do have any other questions, do post them in the chat. We'll kind of wait for those. All right, then. If that is for questions, thank you for joining us. This has been a very, very wonderful. Okay. Yeah, I can just see it now, sir. Super. How much emergency fund corpus you guys advise or suggest in general? Is it like based on months or years of expense? Sir, yes, sir. It'll vary, but usually the thumb rule is that 6 to 8 months is the minimum, sir. If you have 12 months, super, that is well and good, but at least have 6 months in place, because that is something that we highly recommend. Even before you start off things like a PMS or an asset allocation, having 6 months of emergency expenses in a debt fund or an FD or a savings bank account is highly recommended. Damo sir asks, if bought sovereign gold bonds but interest not credited this quarter for Jan to March, what might be the reason? Sir, I'm not too sure, because sovereign gold bonds interest.
So actually, sir, you can write to the CDSL mapping your DPID and DMAT account details, stating that the SGP interest rate has not been mapped yet, and then you can wait for the reply from their end. So that would be one thing that you can try out.
And if I'm not wrong, sovereign gold bonds pay interest half-yearly. They do not pay interest quarterly.
Yeah, 6 months.
So 6 months. So 6 months is when you should be expecting. But either way, as my colleague said, Vinayak said, it should be that should be a good option. What we have, yeah. Either way, the registered bank account is where the interest gets credited automatically, sir. So yeah, got quarter till last year. Okay, sir. Then I think writing to CDSL would be the best option for you, or inquiring with your bank as well, because they might have something in place. Okay. So thank you guys for joining us on this wonderful Saturday afternoon. It's been very fruitful. Hope you guys have a very nice weekend as well. And please do contact us. We're always available. We've dropped our numbers in the chat. Do contact us. We'll be more than happy to assist you with whatever queries. Either it be a PMS, either it might be mutual funds, either it might be debt funds. So whatever it is, we are happy to assist you guys in this regard. Again, thank you for joining us. It's been a pleasure having you guys.